So good afternoon, everyone, and welcome to this webinar. It's great to see so many people joining us already and from all over the world. I think we expect this to be very much a UK-centric webinar, but it's great to see people in from Trinidad and Tobago, Namibia, Bahamas, I think, or Barbados I saw, as well as all the way across the UK. So welcome to you all, and hopefully you'll find this a really informative and insightful webinar. We're really focusing here on the global economy and the performance of supply chains this year. We know it's been a year of disruption and challenge for us all, but also probably quite importantly for us all, looking forward into next year and trying to get a sense of where this is going, what's going to change, and therefore what do we all need to do about it in our roles in procurement and supply. So I'm Duncan Brock. I'm one of the leadership team of CIPS, or the Chartered Institute of Procurement and Supply, and delighted to have the honour of chairing this session. We've got two very eminent economists to share their insights with you today. And normally we have one, and it's great to be able to have two and to get their different perspectives on what's going on in the economy and in supply chain. We're going to have Chris Williamson joining us in a minute. He's from IHS Markit, who sort of pulled together the PMIs, and he's going to be giving his perspective of the global PMIs and the UK and what it means and what they tell us. And I think any of you who look at the PMIs on a regular basis, very important indicator of in the economy, watched by analysts, watched by the monetary committees, and also very good at giving a bit of an insight into the future as well as looking into the past. So we're delighted to have Chris joining us in a minute. And then we'll also have Glen. John's a CIPS economist. He's also a professor at the Cranfield School of Management. And John's going to look at the global economy, but particularly the disruption in supply chain and what it means. But I suppose also, again, looking forward, what we're going to be doing about it going forward, because this isn't a short-term problem. And we're definitely going to be facing challenges, us all, as we go forward over the next 3, 6, 9, 12 months. As we look forward through our strategies and our plans in our supply chain and across procurement. So it's going to be great to have the two of them here. What we're going to do is get them to give their views and insights, and then we're definitely going to make sure we have time for Q&A. So you've been brilliant so far at putting stuff into chat. It's been great to see the places where you're all from. Please use chat if you want to continue to leave comments and messages. But also, if you've got any questions, please put them into the Q&A in the section. We'll look at them, we'll keep an eye on them, and definitely make sure at the end we have plenty of time to ask some of those questions to Chris and to John and their views and their perspectives on what's going through. So that'll be really good and a great opportunity, hopefully, to get some insights from you. Actually, talking about insights, before I bring Chris in, it'd be really good to maybe get your participation initially. We thought we'd run 2 or 3 polls as we go through here as well. So the first poll is going to be very much around a sense of what's going on in the supply chain currently. So I don't know whether we can sort of pull up the first poll and maybe ask you to give your perspectives on the supply situation for your companies. So here's the first question. When do you think the supply chain situation will change for your company, and when we return to a level of normal? You've got a number of choices there. When you get if you could quickly just sort of take a view, click on one of those. It'd be great to get your views of where you're currently at and what you're looking at in terms of the supply situation for your companies. I'll give you a sort of few seconds to do that. Don't know whether or not we've got any good results coming in. So maybe good to get those shared. Oh, here we go. So it looks like we've got majority of people are going, we've got mid to end of 2022, and some taking an even longer view that it's actually going to be stretching through into 2023 and onwards. So I don't think any of you are really looking at, well, a few of you, 3% saying you'll be out of the woods by Christmas. But I think everyone else is taking a view that these disruptions are going to continue. So thank you for that. Really good perspectives. I'm sure we'll come back to that. So let's get on to the first economist that we have to share us. So Chris, if you could join us, that'd be great. So Chris Williamson is the sort of Chief Economist at IHS Markit. And Chris, I'm going to hand over to you to give you a chance to share your views of the PMIs and their perspectives and what that means for us all. So over to you.
Thank you, Duncan. Hello, everyone. Great to see so many of you joining. Apologies, I've got sunlight in my face and my lighting's doing all sorts of things, but that doesn't matter because I'm going to show you some slides rather than myself, and they will be unaffected. So I work at IHS Markit. I'm the chief business economist here and responsible for producing the business surveys that the company pushes out, known as the PMIs. Obviously, in the UK, we work with CIPS, and we now produce similar surveys right around the world. Every major developed and emerging market, we produce these business surveys covering manufacturing and services. And it puts us in this superposition whereby we can get a good handle on the global economy on a very timely basis. So the chart I've got here on the left, this is the sum of all of our data around the world. So there's about 30,000 companies providing information that feeds into this green line here. This is our global output index, and it maps against global GDP, which is shown as the bars. You can see it generally provides a very good indication of what global GDP is doing. The important aspect is, of course, that we're available well ahead of the GDP numbers by several months usually. So we get an advanced steer on where the economies of the world are going. It doesn't always map exactly. Sometimes you get, for example, a huge surge in soybean exports or something like that, which will affect GDP. The PMI doesn't pick up things like that. Instead, it picks up the underlying trend in the global economy. As you can see, does it very well. We were very early on in indicating the downturn of the global financial crisis back in 2008 and the subsequent upturn and the ups and downs we've had since then, most notably the pandemic, where the PMI sank to levels never previously witnessed. GDP sank even more, actually. The surveys don't fully capture when everything locks down totally. If you have a total shutdown of the economy, the surveys don't capture that precisely, nor the rebound. But it did give you a very good idea of the severity, unprecedented, and the strong rebound. Most recently, what we've seen is very strong readings in the second quarter globally of 2021 as economies opened up. That's faded somewhat in the third quarter, still strong. As you can see, our index is pretty much in line with its kind of long-term average and even ticked up a little bit in September, which is the latest number you got there. But so off those peaks, but still fairly robust growth. Now, the right-hand chart I've got here breaks that output index out by its two main constituents, that's services and manufacturing. And I've mapped these against, this is our COVID-19 containment index. So this is a gauge of how locked down economies have been month to month. So this is derived from official data on things like enforced closures of businesses, mask wearing, travel restrictions, and so forth. Put them all in a basket, look every country, and you can aggregate those globally. So we saw here when the lockdowns were first instigated in 2020, PMIs fell. As they were relaxed, PMI bounced back. And since then, we've seen this sort of wavy pattern whereby you had a further lockdown effect in late 2020 as we had the second wave and relaxation of those, and more recently the Delta wave, leading to some further milder restrictions being implemented. And that has been a contributor to pulling down these rates of increase, most notably in services, but also in manufacturing as well. And it's very interesting to break these down by regions of the world. On the left-hand side, you've got the developed world and the emerging markets broken down by services and manufacturing. Now, the strongest increases we've seen over the last year, and especially in the summer months of 2020, has been in the developed world, both in manufacturing and services. Surging activity now, and much stronger than in the emerging markets in both cases. Now, there's two reasons for this. One is that the developed world has had a lot more stimulus than the emerging markets, both from central banks and from the fiscal side, supporting the economies. Emerging markets, far less stimulus going in there, but also more importantly, there's the vaccines. The vaccine dividend that the developed world saw led to this huge opening up of these economies. The reverse has actually happened in the emerging markets, where we've seen in economies such as China and Southeast Asia, factories being shut down again, port closures and so forth, as the Delta wave has led to this these further restrictions being implemented, dampening that activity. So there's a massive divergence here between the developed world and the emerging markets that we've seen. But let's stick to the developed world for now. And you can see on the right-hand side of here, this is flash PMI data for October. So these are early cuts of the PMIs based on about 85% of normal responses, gives us a good idea what the final numbers are going to say. Those final numbers for October are going to be due next week, but our little sneak peek into them provided some pretty encouraging signs on the output side, with generally lifting higher. The Eurozone dipped down, but US and UK saw growth pick up. Now, services led as these economies continue to open up somewhat. US in particular, Delta wave fading, case numbers coming down. UK, case numbers rising, but as we all know here, no restrictions being applied. So in effect, the economy is still pretty much opening up. Encouraging to see Japan picking up as well, returning to growth. So October hints that some of this slowdown that we've seen is beginning to reverse out. But it's not the case for manufacturing. This is services led as those economies opened up. In manufacturing, it's a different story. Look at these indices here. The green line is US manufacturing output. The blue line is Eurozone and the red line is the UK. All of these falling sharply again in October. This is the latest data we've got there from those flash numbers. So the situation in manufacturing in the Western world, if you like, continuing to deteriorate. And generally, these are the weakest expansions that we've had in this initial recovery of the pandemic over the last 18 months or so. So situation turning really quite sour. And this is supply disruption led. If we jump on here, we can analyze, here's the UK. These are what companies have told us their reasons were for falling output. Now in manufacturing, supply problems are the predominant cause of output falling. Staff shortage is also a big factor. Weak demand coming in there. Demand peaked and it's in the early opening up, and it's starting to cool now. But you've also got a lot of firms seeing weak demand just because, let's take the example of an auto manufacturer. If you can't buy your semiconductors, you're going to need fewer windscreens, car batteries, and services associated with it. So not surprisingly, as these shortages have really hit some industries, you're getting a sort of spillover to other parts of the economy as well. But this is supply driven predominantly. Staff shortages also coming into play, both in terms of illness, preventing people coming into the workforce, but also just a general lack of availability as the pool of labour has been diminished by COVID. So supply problems are your main issue here, and we can see one of the features of the PMIs that is unique is to be able to drill down into the fine sectors of the global economy. And with those supply chain disruptions, we can clearly see the worst affected industries. My bar chart on the right ranks all the industries globally by their output growth in September. And the steepest downturn by far seen in autos. Construction materials also faring badly in recent months as well as sectors like household goods. The time series for these bars are shown on the left. You can see just how quickly things turn sour for industries like autos with those supply constraints limiting output. But it's not just manufacturing. An interesting one here is software and services, the orange line, where we can see here things like semiconductor shortages, electronic component shortages, limiting what some of these service industries can also do in the way of servicing their clients as well. But it's much broader than some of these industries that are hitting the headlines at the moment. And we can see quite clearly here just how much output is lower than demand, really. Demand's still reasonably strong. Yeah, it's come off the boil, but this chart shows us where order book growth is rising faster than production. So this is the production shortfall, just companies not being able to produce as much as customers are demanding. and that's most prevalent in the autos industry. Again, tech equipment, software services, machinery and equipment, it's manufacturing led. So, I mean, these are the ones that we would expect to see, but just the severity of it seems to be getting worse and worse in recent months. Now, those supply shortages globally, they're illustrated by the green line in this chart. This is our suppliers' delivery times index. The higher this green line goes in this chart, the more the supply delays that you've got. And in recent months, these have been unprecedented in the degree of to which supply chains have lengthened. A little bit of an easing in September, but from what we've seen as the flash data that we've got for October so far, I wouldn't be surprised if these supply delays are even worse than they were in September. What you see generally is when these supply delays get worse, prices rise. Suppliers have more pricing power. And that's mapped by this orange line, which shows manufacturers' global input prices. So supply delays get worse and worse, prices rise. And this is what we've seen recently. In fact, I'm a bit surprised that we've not seen prices rise even more than they have done. A part of that is some cooling of demand evident, but these are pretty unprecedented price hikes given the latest 10 years history that we've got. And if we look at these by country, we can see when you look at the developed world, that was global before, they're actually unprecedented in our survey history. So this goes back to about 20 years. So input price inflation in the US, UK, Eurozone, Japan, and Australia here, those are our flash surveys. These are record rates of increase. And if you map those data collectively against global consumer price inflation, as we see on the right side here, the green line is the PMI, and importantly, it's advanced 3 months against global consumer price inflation. It looks like global inflation has gone a lot further to rise than we've already seen in recent months. So huge pressures there on prices as the economy slows, which presents a very interesting situation for policymakers at the moment. So my chart on the left here, this is for the UK, but it's a similar situation in the US, Eurozone, and in other economies as well. So what you've got here, the green line is output growth as signaled by the PMI. We saw that peak in the second quarter, has come down recently, but still reasonably robust. And the lighter green line is input prices across manufacturing and services, this record rate of inflation being recorded. The orange bars shows what the Bank of England has generally done in response to these signals. And you can see here that when especially output growth increases, then they tend to hike interest rates. You get an index reading above sort of 53, 54, tends to be sort of rate hike mood. And below that, you get into rate cut territory. So at the moment, there's very much from the price angle, very much a prescription of yet hiking interest rates, but it's a bit more nuanced from the output side, where historically you don't generally see the Bank of England hiking interest rates with this sort of modest rate of growth that we've got at the moment. The big question, of course, is where do we go from here? Now, my chart on the right adds to the debate here. So the growth in manufacturing services in the UK has obviously followed the COVID containment path quite closely over the last 18 months, 2 years. And it looks like what we've had in latest months is we've passed that big opening up of the economy, leaving really growth more susceptible to the fundamentals facing the economy. So the big question now is, have we got more oomph in the services economy to keep driving growth, or are we going to see things fade after this rebound has passed? In manufacturing, it certainly looks like things are going to remain constrained for some time. Those supply delays you've seen, they're getting worse in October, not better, feeding through to ever higher prices. And that's going to take a while to unwind. Obviously, those supply and price indices, historically elevated, they're going to take a long time to come down into territory that we're comfortable with. So manufacturing looks like it's going to be squeezed for some time. So leaving services as the main driver of growth in the UK economy. Has it got the resilience there to persist? That's the big question that we're going to be looking at. So perhaps that's a good point to now hand over for, I don't know whether it's Duncan or John going to take over now. Sorry.
Chris, that's really good, thank you, and certainly a perspective on PMIs and the insights there that were excellent. And I suppose we haven't got any questions coming through yet, and people are probably just building up their views of it. But maybe before we bring John in, at the beginning we asked about the view of shortages and whether it will get back to normal. The general view in there was going to be sort of mid to end of 2022. I think what you've just shown there is still a level of significant, problems in supply chains, delivery times going out, inflationary pressures coming through. So I think what you're seeing is it will take a while before it gets anywhere near back to a level of normality in the way that you described it.
It's certainly looking that way. Yeah, it's interesting to see that, near half of all people that we polled saying it's going to be the end of next year. I think our data are generally consistent with that sort of view. Although we've got, the Delta wave fading, lifting some production over in Southeast Asia in particular. China's still suffering, and the conversation will move from whether we can produce stuff in countries like the Southeast Asian economies to once you've made it, how do you get it over to Europe, to the US? Yeah. That's going to be the real crux of the problem now, I think, as those vaccination rates start to improve and you get more production going on. It's how do you shift the stuff, which is perhaps a nice segue into what John's going to talk about.
Yeah, I think you've probably done a better intro to John than I could have done. But John, before we bring you in, we've got another poll we'd probably like to run just before that, because one of Chris's points was about policymakers and looking at the output index, looking at inflationary pressures and deciding on whether or not they should do things like raise interest rates. So particularly for those in the UK, we've got a very specific question for you about whether or not we should be raising what the bank should be doing, really, Bank of England, in terms of interest rates. So I don't know if we can quickly put that poll up. It'd be quite good to get a view of whether or not you think now is a good time to raise interest rates, or whether it would be a mistake. Very binary answer here. You don't have much time to choose one or the other, but it'd be good to get your take on this. And then if you get it right, then you could sit on the Monetary Policy Committee and give your views on Thursday, whenever they sit to debate this. So let's have a quick response from you all. What do you think? See if we can get the results up. Okay, so some of you thinking it'd be a good time to start in policy, and probably all of you who've got a mortgage would probably be saying now's a bad time to raise it, it'd be a mistake. But I think generally that sense of, I think Chris, you were saying the economy is still not in a stable place, and therefore, is the view that any impact on interest rates could actually have a negative impact? I don't know if that's where you were coming from on that.
That's interesting. So twice as many think it would be a mistake as correct. I mean, I'm quite torn. I see very much there's a scope to pull back some of this stimulus that was put in place specifically for the pandemic, right? There was a more emergency quantitative easing put in play there, and arguably, some of that should naturally be unwound now. But I just wonder, is now the right time? You've got so many factors coming into play now that are, forecasting 2022 is just a nightmare. I'm glad it's not my job to do it, because there's so much going on, especially in the UK. I mean, we've got Brexit conflating all the other issues that we're facing with things like the universal credit withdrawal, and let alone the supply chain issues. And I think there's a lot of uncertainty. We've not really seen the furlough scheme being properly unwound and the effects of that. So while I get the whole thing, time to remove some of this emergency stimulus, but is now the right time? What's the harm in waiting another couple of months?
Right. No, really good. Thank you. So Chris, thank you for that. I'm going to allow John to sort of share some of his insights now. So John, welcome to you. Thanks for joining us. So I said at the beginning, John's sort of economist for CIPS. He's using a lot for sort of commentary and views on the perspectives of the economy, but also he's a professor at the Cranfield School of Management. And John, thanks for joining us. And maybe if I hand over to you, give you a chance to give your views and perspectives, and then we will come back to some of the questions that I see are being put into chat. Actually, if you are putting any questions into chat, if you'd help us, could you put them into the Q&A? Because that will allow us to actually sort of sift and sort them and maybe ask both Chris and John towards the end. But John, over to you.
Cheers. Good afternoon, everyone. Thank you, Chris, for a fantastic presentation, and also for the link that you made in terms of, yes, we will recover. Yes, our chip factories will start producing. But the problem that we've then got is we've got to get our chips into the manufacturing process so that we can start producing the cars. And then once we've got the cars produced, we have to get them to the end user. So I'm going to look at some of the issues that we've got in global supply chains in relation to moving those goods and services, and how that is likely to evolve over the period that we're looking at here, 22 and into 23. So we've seen significant supply chain disruptions in 2021. I'm going to look at sort of making a distinction here between what I might call systemic and ongoing supply chain challenges. So obviously COVID has systemic effects. As Chris hinted at, Brexit will have systemic effects. I think I said recently that the cloak of COVID is wearing relatively thin. I probably got that wrong. But what that will then reveal for the UK economy is the impact that Brexit is having on our supply chains, and we'll have to deal with that. And then if we look forward to some of the bigger systemic risks that people are starting to talk about, McKinsey's, for example, they've got cyber attacks high on their list, and they've also got environment high on their list. And they're systemic challenges that we have to deal with, and I'll talk about those in a moment. More, run of the mill, as it were, and it seems trite to describe them that, is the whole list of challenges that we face on an ongoing basis, which is the day-to-day stuff of the purchasing managers who are on this call. So the challenge is to build agility, elasticity, plasticity, what we might call resilience into our supply chain. Now, for the normal challenges, the non-systemic challenges, this requires business insight. It requires to anticipate what's likely to happen in our supply chain, amount of planning and clarity about how our supply chain is configured, and then quick thinking and collaboration with our supply chain partners when something happens, employing the right technology so that we can collect data on our supply chain and the connectivity inside our supply chain. We can monitor we can monitor disruptions in those supply chains, develop solutions, take actions, and then exhibit the agility that allows us to keep our supply chains intact and acting for us. But the big issue is, what do we do when we get these systemic challenges? The systemic challenges of COVID and the way that has played out in the impact on our economy, the impact on our individual sectors in our economy, and the impact on the overall economy that Chris outlined so clearly in his presentation. Well, there's some pretty big trends that we've got to look at, and I've drawn down on US data here, because it identifies some big issues that we're going to have to deal with, but also the impact of what's happening in North America and Asia will also have impacts on us and on Europe as the global economy seeks to readjust. So first of all, if we look at retail sales, and particularly what I want to look at here is the ratio of inventory to sales in North America. And what we've seen in the period of the pandemic is a collapse in that ratio of inventory to sales. So essentially what we're doing is we're holding much less inventory because the goods and services are not available in the way that Chris outlined quite clearly. And therefore there are two things there. First of all, we're likely to see a lack of supply at the point of sales. And notice I deliberately didn't talk about shortages there, because it is quite correct to say that there is not a shortage of goods and services in the system. What there is a shortage of those goods at the point of sale. So it's getting these goods and services to the point of sale that is the issue. Now, what we're likely to see then as we return to more normal times, okay, is a surge in the demand for goods and services as we seek to return our inventories to more normal levels. For those of you who've studied logistics at university, the so-called bullwhip effect. But the issue here is we're likely to see that on a global scale. And what are the implications that that's likely to have for global inflation? And also, what are the implications that it's likely to have on the global supply chain capacity to deal with that increase in demand as and when it occurs? So the picture that we've all seen is port congestion. And if you've seen a photograph, a specific photograph, you've probably seen the Los Angeles Long Beach cluster. As of the mid-September, there were 62 vessels waiting at anchor to try and get a berth in California, with the average wait now being 3 weeks at berth. So what does that mean? That means that a vast amount of capacity is being taken out of the global shipping capability. But Long Beach may be the story that you're seeing. Some of you know that I work closely with Kuehne+Nagel. Other forwarding providers are available, but Kuehne+Nagel have a tool called Sea Explorer, which maps where every container ship on the planet is at any point in time. And currently there are 639 container ships at anchor waiting to get in to our ports globally. That is twice the number that existed at this point in time last year. So essentially what we're seeing is a large quantity of the global vessel capacity being taken out of service because it's essentially sitting waiting to offload its cargo at ports around the world. Now, typically we would have between 2 and 4% of the global fleet being absorbed due to delays. Now that is closer to 11%. Okay. Now, what we actually saw, if we've got the longer term data on the left hand side, shorter term, which is looking at the pandemic, we did see some easing of this in the earlier months of this year as the impact of COVID eased somewhat. But obviously, as we go into the second wave and third waves of COVID in some countries, what we see is that absorption of capacity increasing again. And frankly, this starts to justify the type of expectations that you've got about how long it's going to be before we see sea freight returning to some degree of normality. So here we see, industry analysts saying that, between 20 and 25% of capacity trans-Pacific, 12 to 13% of capacity between Asia and Europe is being absorbed by congestion. And this also relates, to our ports being congested, trucks being congested, rails and chassis are not moving the goods away from the port. So we can't offload imports, we can't move the goods through the ports, and there is congestion and lack of capacity away from the port. So systemically, our supply chains are in pretty poor shape, and that's causing the type of shortages that we're seeing, and the impact on global supply chains passing through to global output in the way that Chris clearly outlined in his presentation prior to mine. So again, that's then being reflected in the price that you're having to pay for your containers. The Drewry Index of global container rates, bumping around the $2,000 prior to the pandemic, and now up at $10,000 per 40-foot container as of September this year. But the issue here as well, guys, is we can't avoid it wherever we are. So this is looking at the container rate Shanghai into Europe, Shanghai into the Mediterranean, Shanghai into US East Coast, West Coast, South America, and Australia. All trades are being hit. There is lack of capacity on all trades. But a slightly worrying observation for us here in Europe is that although our ports are not quite as congested as the ports in North America, it would seem to be that we are paying a higher premium for the lack of global supply than is the case on the busiest routes, Trans-Pacific and into the East Coast of the United States, and even in South America and Australia, which would tend to suggest that global capacity is being sucked out of the European routes, and therefore whatever capacity is being left is being priced at a premium and a significant premium compared to the congested ports of North America, South America, and Australasia. So looking forward then, factors that we need to consider. The key issue is that, and Chris sort of alluded to this, is that GDP forecasts for 21 and into 22 see relatively robust global growth. So there is going to be continued demand. This will drive product demand and it will drive the demand on global supply chains to be robust. It will drive the demand on global trucking, global rail, global sea freight, global air freight to deliver, okay? The problem is that the capability of those systems is likely to be significantly damaged, as it were, well into 2022. And I think the sort of mean or median expectation that there will still be problems with us into the end of 2022 is probably a good basis upon which to do your planning. As Chris suggested in the answer to one of the questions that he gave prior to my presentation, there is an issue about government spending and support. There has been huge support for spending throughout the pandemic, and we've seen a significant fiscal impetus in the United Kingdom with the latest budget this week, and that's going to start to push significant amounts of demand into the economy, and again that will put pressure on global supply chains, which at the moment, as I've suggested, are not in the greatest shape to respond to that. We see that retail inventories are very, very low. We're experiencing that. Most of us have got, experience of going into our local shops and seeing, if not our shelves being emptied, at least the goods being dragged to the front of the shelves in order to create the impression that there is an amount of supply. So we're likely to see those inventories being rebuilt. And again, that will put increased pressure on those global supply chains. And then we have, the additional issue, and Chris may want to comment on this, that our personal saving rates are well above, in the United Kingdom, double historic norms. And this will fuel consumption. It will fuel increased demand as we come out of the pandemic, as consumer confidence increases, and as people go out and spend more of that money that they saved during the pandemic. There is an issue then about, will inflation hurt the economy and spending? The question that we asked before this presentation, are we likely to see a dampening of demand, okay, an increase in interest rates in order to head off inflation? And again, that might be something that we wish to discuss in the questioning after this presentation. So thank you for your attention. Hopefully, Duncan, I've left enough time to answer some of the questions that were likely to be asked. I see a smile there, so that suggests that the one or two gems that people are lined up for us. So over to you. I shall stop sharing my screen.
Brilliant, John. Thank you for that, and for the insights there. And for me, it's really interesting just to sort of see two different perspectives, but obviously the same challenges coming through. We have got a number of questions that have come through that I'd like to get to. Actually, just before we get to the questions, because a bit more food for thought for us probably, I would just like to have one more poll of the audience here, and this probably links to both Chris's and John's presentations here, because I suppose one of the challenges we all face in procurement and supply at the moment is, so what are you going to do? What's your strategy? What's your plan to overcome some of these issues through the supply chain, or the systemic challenges, I think, as John described them? So we've got a poll, which is really to talk about what are your strategies? What's your plans around your longer term supply chain management? So maybe if we could put that poll up, and as you've done before, it'd be really good to get you to answer this. You have multiple choice in this case, so maybe we'll give you a couple of minutes more than we had. But if you're looking at the long-term impacts of the pandemic on your supply chain, what are you doing? Doesn't it affect you? Are you changing the complexity of the specifications? Are you simplifying? Are you changing product offerings? Holding more inventory? I mean, John just talked there about inventory and issues associated. Are you sourcing more locally? And also then, are you strategically investing vertically or vertically integrating your supply chain? So be very interested. You can choose as many as you want. It'd be very good to get your views and comments on that. And then we will open it up to the Q&A, because we've got a few really good questions coming through. So I think that's probably given people enough time. Let's see what results we get from that. Okay, so 8% of you are very happy. It hasn't affected you at all. Congratulations. I'd like to talk to you, because everyone else I speak to is having some challenges. A lot more people holding inventory. A lot more people, and that I think is a trend we're seeing across the board. And maybe that is part of the challenges that John was talking about. A lot more people looking at local suppliers. So as a tactic, vertical integration. I mean, that's kind of long-term strategic change that's going to take place as you go through. And a bit of work on simplifying or standardizing specifications and some on product offerings. Really interesting perspectives. Thank you for that. We'll come back to some of those themes, I think, as we go forward. I don't know, John, Chris, do you want to comment on what you just saw there?
Sorry, John, go first, please.
Yeah, it would be really interesting with the inventory question to see whether or not that was something that people would like to do, or something that people were actually capable of doing. Because, if you follow the sort of tenet of what I was suggesting, the issue is that it's difficult to get inventory. So I think we'd all like to hold more inventory, but it's whether or not we can actually get the inventory in place. So it'd be interesting to see whether people are colleagues are able to actually obtain that inventory.
Yeah, that's good. That's a good comment. Chris, your thoughts?
Yeah, I mean, with the PMIs, I mean, we can analyze, as we saw briefly then, as reasons why output fell. One of the reasons why firms have been buying more inputs is an unprecedented degree of safety stock building, which has obviously exacerbated the whole demand-supply imbalance. Companies not wanting to be caught out again with a lack of certain inputs, so buying more and more and more. So as adding to the problem, it should obviously diminish that as an issue once we've all got sufficient supplies in there, but it looks like we're not there yet. But it's fascinating to see, this structural shift that the pandemic seems to have caused. 2/3 of the people responding saying that they've shifted to more local suppliers trying to find things, and 32%, 1 in 3, investing in supply facilities themselves. I think that's a really strong number. It's very indicative of a structural mindset change here. Look, this might happen again. Let's make sure it doesn't. How do we do it? Let's start investing vertically into making our supply chain secure. I think fascinating.
Yeah, and I think that certainly chimes with me in terms of the discussions I've had with procurement leadership teams and their strategies. They're basically shaking out all their sourcing strategies and looking again. The original strategies they may have put in place 5-10 years ago, they're now going, that's not fit for purpose for the future. It's not giving us the resilience or the flexibility we need, or the traceability and the visibility that we need as well. So I just sort of chime with that. Let me get to some of the questions, because they're flooding in now. I'm not sure we'll have time to get through them all. But Ollie Bartram's was one of the first ones that came in. And actually, it was directed initially at you, Chris. It says, Chris, do you think the relationship between PMI input prices and CPI is the same as it's been historically, or are there reasons to expect pass-through to behave differently in the current context? So you talked about a real spike in input prices that we're seeing. Is that going to feed through into CPI?
Yeah, I'm more confident now that it will follow the historical norms than I was a while ago, because we're now seeing these official measures of CPI inflation surge higher. Just today, for example, Eurozone inflation up to 4.1%, the highest that we've had since 2008. And, you know, for a few months now, we've been saying Eurozone inflation is just going to keep going up and up and up with our fingers crossing. And, you know, we better be right about this, because this is quite a strong signal to be sending. And sure enough, all these gauges are following those PMIs higher. It looks like it's just the same as usual. You get firms' costs rising, they pass through to the factory gate prices. Service providers then see, you know, if you're a restaurant or something, your food prices are rising, your transportation costs are rising, and that feeds through to us consumers at the end. So it looks like the norms are applying here. One thing that relates to another question as well, which I think we can follow on quite nicely from there and link something to what John says, is the savings rate. And, you know, how is that going to affect things going forward? There's this huge accumulation of savings, not just in the UK, but especially in the US as well, that a lot of people are pinning on driving growth. If you look at the Office of Budget Responsibility, they've got 6% growth forecast for the UK next year. And that's largely predicated on household spending surging by 6%. This is almost unprecedented growth of consumer spending. And that seems to be all about savings. You know, we've amassed all this money, we're going to spend it. So on that basis, you'd expect this pass through to could be even greater. You know, if there is that much pent up demand for us to buy stuff and it's limited in supply, boom, inflation's gonna really kick off. But the one caveat to that, I think, is that, you know, who's holding these savings? There's not a lot of clarity on that, because what we've seen before is, if these savings are concentrated amongst the wealthy, it doesn't tend to be spent in the same way as a more equitable distribution. So inflation is all about not just the amount of money in the economy, but its velocity of circulation. And if you don't have that money moving around, you don't get the inflation that you would otherwise. John's smiling, a bit of 101 economics there. But that's what we've seen before. That's why inflation has not proved sticky in the past. You've not had that, although that amount of money, that wealth, actually spinning around the economy, driving prices higher. It's going to be interesting to see that.
Yeah, and I think it was in a webinar on Wednesday, and one of the discussions there was about, you know, people leaving the workforce. One of the comments that was made in there, I think, was that people have built up some savings, and actually that allows them to not work as much or retire early, and actually, you know, therefore they're going to use those savings to sort of buffer them rather than actually getting back into full-time work. I thought that was a very interesting perspective on the dynamics of the labour side of that impact as well, which was I think an interesting take. John, I'm going to ask you a question. Sorry, John, let you come in.
No, just on that point, because Chris made a point in his presentation that it was you know, supply chain fractures, but also a shortage of workers. And I don't think the effect that you've talked about, Duncan, is trivial, because I think there are a raft of people between 55 and 60, some of whom may be at the end of the defined benefits pension sort of capability, you know, before you know, everything changed as far as that's concerned. They built up an amount of savings. They've had 2 years where they've not been in work or not worked as much as they have in the past, and they actually are turning around and saying, I quite like that and I'm not going back to it. Yeah. And I think there may be a significant effect there, most obviously in the health service.
Yeah, no, that's a good point. So right, let's try and rattle through a few questions. This is one for you, John. This is from Joe Bell. Are those in control of freight manipulating the current situation to increase profitability?
They're not manipulating the current situation because they don't have it. Are they making vast amounts of profitability? Absolutely, yes. Okay, and that goes from the freight forwarders through to the truckers, through to even the shipping lines. So the carriers, which which occasionally are very good at making very big losses, are making phenomenal profits. And if you want the slide, I'll put the slide into my presentation. Yeah. It is there. I thought I presented enough numbers today, so yes is the answer to that. Yeah.
I think we'll just remember the number 639 because that's the one that stuck with me. So thank you for that one. I'll use that one again. There's a question here from Mark Chalacombe. Whilst we all acknowledge the supply chain constraints in the electronics industry, do you feel 2022 is a year best planned for survival rather than growth or new product introduction, especially for smaller companies with the risk of failure, the risk of failure is higher due to component shortages? So it sounds like the question is, do you hunker down in 2022 and just sort of see it through, or do we think that the shortages will start to ease and companies can start to look for investing in growth and new products? It's a very much an interesting question. Chris?
Yeah, I'm quite nervous about it, to be honest, because we're, from our pricing and purchasing team here at IHS Markit, we're monitoring the whole global supply situation in fine detail, and there's lots of concern about supply issues for very specific commodities. The next one seems to be electrical steel. It seems very limited supply, and it's the sort of thing that takes a long time to build further production capacity for, just like the semiconductors. So we're already eyeing, what's the next big issue going to be after semiconductors, and it seems they're stacking up. So yeah, I mean, I'm quite cautious about 2022 in the outlook. I think there's a lot of forecasts out there that are looking quite peaky, and I think the supply situation is going to curb global growth, and so be tempted to be more risk averse than gung ho about next year from my perspective. John, I don't know whether you.
Yeah, I don't think it's time to be gung ho, but I think, Chris, you sort of illustrated the point I was trying to make in my presentation, that if there are supply chain risks, that we do have to get all over the data, and using IHS Markit, it's a fabulous tool to drill down into specific sectors and look at where the next issue is likely to come from. So yes, it's all about managing risk. It was ever thus. Yeah, it is a much riskier environment, and therefore, we have to spend more time doing that kind of stuff. But if we are managing the risk, if we are monitoring the risk, if we do have a high degree of confidence about the inputs that we're likely to need, about the resilience of our supply chain, then go ahead and seek to grow your business, but be aware that we are in a riskier environment. So I think, it goes back to that point about, data, analyzing the data, developing options, and then putting it into action. And I think you've got to draw down on high quality data where it's available.
Yeah, that's a really good point, John. And I think anyone in procurement and supply, often they don't take enough time to get hold of the data. There's often data is available and it's around them, but actually getting it, analyzing it, and doing informed decision making, I think, is a really important point. And actually, I'm going to come back. One of the questions that's come up from Mr. or Mrs. Anonymous is around local and near sourcing. So, one of the responses to the last poll was more people looking at local sourcing. And the question is around that, is local or near sourcing going to get a big boost now that businesses are being spooked? Or will supply chains go back to just in time, which make goods cheaper for consumers? So it's really, are you going to do more now, or will they go back to the old way of cheap and cheerful single sourcing out of Asia? And if they do stay as being near sourcing, is that also going to be driven by a sustainability and environmental need to change supply chains forever? So actually, that being a good thing. So that's sort of, with COP26 underway at the moment, that's probably a good topical question around that. So comment on that, guys.
There's about 4 questions there.
I know there was.
So the interesting observation for me, because I've made this comment in the past, is we saw an increased desire to nearshore, to onshore, whatever we want to call it. It'd be interesting to see whether the capacity and capability is actually there to deliver. If it is, I think that's a trend that people will move to in the short term. Do we think we'll go back to the supply chains that we've had? You know, I think you called it cheap and cheerful. I think I don't doubt that we will. You know, I know initially comments that I've made at conferences where colleagues have come up to me and said, well, that's just what we do. You know, and if today it's about nearshoring and onshoring, that's what we'll do. And then if the opportunity in 2 or 3 years to go further afield is the optimal thing to do, well, then that's what we'll do then, and we'll manage the risks accordingly. And then just quickly on sustainability, I think, and again, I've said this a couple of times in presentations, I think for 20 years I've been listening to a lot of greenwash, and now that's no longer the case. Your customers will not accept it anymore, and they'll take their customer favors elsewhere, and I think there's a lot of pressure there. But what I'm hearing increasingly is that investors now are actually insisting that organizations clearly show their sustainability credentials and what they are actually doing, not their aspirations, but what they are actually doing.
Yeah, that's a good point. Chris, you got anything to add to that?
Yeah, well, I mean, this is veering off my area of specialty somewhat, but from what we've seen with the surveys and the responses to the companies, is that what the pandemic's taught them is that the price of an input is a lot greater than the cost of that individual unit. You know, if you have to shut down your auto factory for a month because you can't get a semiconductor, those semiconductors cost you an awful lot of money, and it's brought that into focus. What is the cost of imports, and how do you safeguard against this happening again? And one, you know, it was interesting that all that investment into supply chain facilities we saw with the question. You know, if I was an investor or a CEO or something, and my purchasing manager came to me again, you'll never guess what, we've let you down again. We don't have, it's electrical steel this time. I know last year it was semiconductors, now it's electrical steel. I'd be questioning what you've been doing, right? It's fair play to be burnt once, but twice. So I think you're going to see a lot of people building in more safeguards, and they can justify it now. You can justify the expense of storing, of producing nearer, sourcing nearer, and so forth. So I think this is a long-term thing.
Yeah, and I think, you know, that view of the long term probably answers a few of the questions that are coming up about what's the sense of when things will change and get better. I think both of you are saying, you know, there's some, you know, the systemic problems in the supply chains that will take a while to work their way through. And unfortunately, we're out of time, guys. I mean, I think, yeah, we probably could do another half an hour based on the number of questions coming through, some very specific ones based on the US administration and others, but also, you know, a few other comments as well. But we are out of time. So I think, you know, we probably should need to have another webinar in probably 3 or 4 months' time to sort of see how things have changed and perspectives on that as we go into 2022. But I mean, John, Chris, really appreciate your time today. It's been great to get your insights and perspectives. Certainly, you know, the perspectives both on the freight and logistics situation, the views on the PMI. I'm sure when the PMIs come out in the next few days, there'll be a lot more people looking at them very closely now to see what they say and how they say it and the implications of it. So really appreciate your time. Thanks for everyone in the audience for also participating. It's been great to see the number of questions, comments coming through from you all. So hopefully you've got some real value from that. And I look forward to seeing you all on a webinar sometime soon. So thanks everyone for your time today. It's been brilliant. Thank you.